National Electricity Plan has mandated a staggering 9.16 lakh crore rupee capital outlay to upgrade the country's power grid over the next decade. Rajesh Power Services Limited is capturing a significant share of that capital. Operating as an integrated turnkey EPC player, they posted a 52% revenue jump in fiscal year 26, reaching over 1,600 crore rupees. Rajesh Power generates a 55% return on capital employed and holds an unexecuted order book double its current revenue. Yet the stock trades at a price-to-earnings multiple of just 11.29, while the broader industry is currently valued at 36. This presents a binary scenario. Either this is a severely mispriced small-cap asset, or the market is accurately discounting the hidden margin and working capital risks that routinely damage construction and engineering firms. To find out, we need to map the bullish catalysts against the structural vulnerabilities of the business model. On the upside, the sustained infrastructure supercycle guarantees a virtually unlimited pipeline of state and central bidding opportunities. Add to that an exceptionally clean balance sheet, boasting a debt-to-equity ratio of just 0.31, and a deliberate strategic shift toward recurring revenue streams through battery energy storage systems. Conversely, institutional investors tracking the EPC sector know the pitfalls are severe. The model is highly susceptible to execution delays from land clearances, extreme working capital intensity, and severe client concentration, especially with slow-paying state utilities. Resolving this valuation paradox requires moving past the headline multiples. We have to tear down the company's operational execution and verify if their earnings actually convert to bankable cash. Rajesh Power operates by winning competitive tenders and executing turnkey infrastructure projects, taking substations and transmission networks from initial design to final commissioning. But unlike pure long-haul transmission companies, they concentrate heavily on power distribution and underground cabling networks. Now, the company is shifting its capital allocation. They recently secured a 65-megawatt, 130-megawatt-hour battery energy storage system project for the Gujarat state utility. This standalone facility targets an internal rate of return between 10 and 12%, engineered to generate 14 to 15 crore rupees annually through monthly tariff rentals. This transition directly impacts their market valuation. It begins the process of converting Rajesh Power from a cyclical, project-based contractor into a hybrid infrastructure operator with predictable cash flows. To understand why their core EPC business is highly profitable, look at how the rest of the industry is struggling. Despite the massive capital earmarked for India's grid, the broader transmission sector is failing to deploy it on schedule. This Care Edge ratings chart tracks the annual target versus actual circuit kilometer additions. As of fiscal 25, the industry missed the target by 42%. The systemic delays are well documented. Overhead transmission projects are stalled by grueling right-of-way acquisitions, forest clearances, and land disputes. While the majority of tariff-based competitive bidding projects suffer time overruns stretching from 3 to 18 months, Rajesh Power consistently completes its projects within an 18 to 24-month timeline. They achieve this velocity because of their specialized focus. Underground cabling inherently bypasses the surface-level land rights and environmental clearances that paralyze their larger competitors. In the engineering and procurement sector, speed translates directly to margin. Their structural ability to execute faster than the industry average forms their primary economic moat. With that operational context, we can evaluate their fiscal year 26 income statement to test the validity of the 11.29 PE multiple. Revenue expanded by 52% to 1,627 crore rupees, and profit after tax grew 48% to 143 crore rupees. The operating margin holds steady at 11.6%, with net margins at 8.14%. They scale revenue without sacrificing unit economics. The critical test for any hypergrowth contractor is the balance sheet. We need to verify if this rapid expansion was funded by absorbing dangerous levels of debt. The company's net worth increased by 53% to 406 crore rupees, while maintaining a low debt-to-equity ratio of 0.31. However, the balance sheet alone does not address the core vulnerability of all utility-facing models: heavy working capital intensity and the constant risk of stranded receivables. To test earnings quality, this area chart overlays cash flow from operations directly onto profit after tax. If the cash line closely tracks the profit line, it proves the company is actually collecting capital from state utilities, rather than just recording paper earnings. Corporate governance metrics provide an additional layer of security. Promoters hold a 72.7% stake, and crucially, 0% of those shares are pledged, indicating strong insider conviction. The forensic data confirms a highly efficient capital structure, but any investor stepping in here must continuously monitor debtor days to ensure utility payments do not slow down. Looking forward, Rajesh Power holds an unexecuted order book of 3,326 crore rupees, establishing clear revenue visibility for roughly the next 2 years. This chart breaks down that backlog, showing exactly where their strategic priorities lie. 71% of the capital is allocated to distribution networks, leaving 29% for transmission infrastructure. There is, however, a concentrated geographic risk. Currently, 75% of their active bid book originates from a single state market, Gujarat. Management is forecasting 40% growth into fiscal 27, leaning on a 6,000 crore rupee bidding pipeline that expands their footprint into 5 additional states. While the sheer size of the order book secures near-term revenue, successful geographic diversification is the necessary next step to insulate the balance sheet from single-state payment risks. Which brings us back to the core paradox. Why does an asset generating a 55% return on capital trade at an 11.29 multiple? On a valuation scatterplot, the market's miscalculation is clear. Rajesh Power is being valued alongside standard cyclical contractors, effectively ignoring its superior capital efficiency and the high margin potential of their BESS pipeline. Compiling the data into our forensic scorecard clarifies the opportunity. The business model and financial quality score highly due to low leverage and strong cash conversion, offset slightly by customer concentration risks. When weighted against its 0.31 leverage and 40% growth guidance, the business aligns with the quantitative metrics typically required for a high-conviction institutional rating. The ultimate upside trigger for market re-rating will be the successful commissioning of their initial battery storage project, slated for September 2027. Rajesh Power Services is a severely mispriced proxy for India's grid modernization. It offers a rare combination of deep value and hypergrowth, provided management maintains the agile execution that built their moat.